Strategist, and you're listening to Latinos in Real Estate Investing Podcast. And if you're watching us on YouTube, you're watching Latinos in Real Estate Investing Podcast. Today, I have Charlotte Dunford with me. She's a managing partner of Johns Creek Capital. Charlotte is a graduate of Georgia Institute of Technology, where she earned a BS in business with focus on business analytics, which I'm sure hasn't really done much for her what she does now with investing in mobile home parks. Charlotte, along with her business partner, currently sponsor and have repositioned up 25 value add and turnaround mobile home parks. So this is always a subject that's really interesting to me because I know some people in the mobile home space. I've had some people come on our podcast from the mobile in that space, the space you play in. And I understand it's extremely profitable. And I'm excited to learn from you what you and your team are doing, what you and your partner are doing, and how you guys are growing. So Charlotte, thank you for being here. Welcome to Latinos in Real Estate Investing podcast. And just go ahead and tell us a little bit about yourself. I know that I probably didn't do you enough justice.
Yeah, thank you so much for having me. Hello, everybody. My name is Charlotte Dunford. I am a managing partner at Johns Creek Capital. We currently have 24 mobile home parks under management. And since we started in 2020, which is a crazy year, which was a really crazy year. And right now we have over $4.8 million in investor subscription. So what you just mentioned about my education at Georgia Tech, actually, the training to be an engineer, actually got in as an industrial engineer. So the training as an engineer and the analytical thinking and the critical thinking that it gave me is, I would say, those things really do contribute to what I'm doing today. So that's in a nutshell, a snapshot of what I do.
Awesome. So let's first start with mobile home parks. Why mobile home parks, right? Why is that your strategy? Why not multifamily? Why not single family?
Right.
Not any of the other things and any of the other strategies that you can play in real estate?
Yeah, that is a great question, right? So when I started to start a company, right? So if you want to start any company, there are two questions you need to ask yourself. Number one, is this industry that you're about to go into profitable? Okay, that's the first question. And the second question is, if it is profitable, are you able to get yourself a piece of the pie within the industry? So those are the two questions you need to ask. Can you make the money? Is there money there? And can you make the money, right? So the first question, is this industry profitable? Yes, it is profitable. Mobile home parks, because the market is huge, and mobile home parks is in the first and second year of the 7-year real estate cycle. So just like when you're buying a stock, it is on the bottom of the curve right now. So it's going up. So the market is looking good. There is money to be made, and there is a demand that's ever growing, which is caused by the affordable housing crisis that America faces. And the supply is somehow limited because we're not making new mobile home parks, very little, because of zoning regulations. A lot of legislatures do not like mobile home parks because of the stigma, whatever it is, they don't make them anymore. So when the supply is limited and the demand keeps growing, the market is huge. So there is money to be made. So that answers that question. So the second question is, are you able to make money for yourself? Now, with mobile home parks, yes, the answer is yes, I was able to, because at the time when I started, and still today, the market is not extremely heated, where in multifamily, where those big boys from Wall Street or big boys from all sorts of capital firms, they have been at this for decades. So I found it really difficult for myself to get into multifamily because of the lack of experience when I started when I was 25 years old. And so that space is already too crowded. So I chose to focus on the blue ocean strategy, where there are not a lot of players and not everybody's fishing for the same thing. So when I started mobile home parks, particularly small mobile home parks, which gives me more room for this blue ocean strategy, we were able to get a lot of really good deals and really good value add deals because of lack of competition, the good terms. For example, one of the first deals we got was a seller financing deal with, I think, is 20 to 30% down and 3% interest rate, 30-year amortization, and 10-year balloon. So that's phenomenal as far as terms are. Yeah, that's great. So you are able to do that. Say deals make you successful. So you're able to make that deal because you're in the blue ocean. So that's pretty much the two questions. That's why I chose to do this, because those two questions I could answer.
That's freaking amazing. You said you focus on small mobile home parks.
Mm-hmm.
What is this? What does that mean? What is considered
a small mobile home park is anything from 10 lots to up to 50 lots. Anything more than that will consider medium to big. So if you want to go really big, you're looking at 100 lots and above. Some people go thousands of lots. That's like a small city. But I think for us, small parks, anywhere from 10 to 50.
So anywhere from 10 to 50 is where you focus. And how do you find these deals, right? Where does a person like yourself find these deals? How do you find these and I know you were saying something off air to me about you don't go into big cities. Can you tell us about that? Can you tell us where you go, why you do that, and tell us more about that. Tell us about that.
It's not that we don't go into big cities, but the cities are fine. One of our parks is in the Phoenix, Arizona MSA. So most of mobile home parks are not in big cities. You don't see mobile home park in Manhattan, do you? So there's a reason for that. They're usually more in the rural setting, but it doesn't mean that they're not in a good town. So usually what we look at, they're in a town that has enough population to supply the tenancy. And what we have 15 major parameters in the acquisition criteria. It's an algorithm that we develop internally. There you go. So just put your nerdy hat on and use my Georgia Tech, engineering training to do this. So it's an algorithm where you have developed 15 parameters to qualify your deals. So, big cities are fine. You just have to have a good MSA near it to have the economic hub to provide it jobs so that you have good tenants, right? So as far as how we find it, I think the secret too, not the secret, but I think the best thing to do for anybody who's sourcing deals is for the deals to come to you rather than you going after it. Well, you do go after it, but you have to have a machinery, kind of a mechanism that shifts the deals to you. You have to be connected to all the brokerage networks to have the deal sent to you. And over the years that we have done business, we have relationship with sellers and brokers. We just simply have that relationship and mechanism built up for us to have deals.
Got it. And what are some of the 15 parameters that you look for when you're those guardrails that you check that you guys?
Right. So, rather than a checklist, it's more of a algorithm where the 15, so I can give you some examples. So every single parameter has a weight assigned to it. So let's say, this parameter is extremely important, then the parameter will have a higher weight assigned to it. And then when we look at a deal, we assign a score for that parameter for that particular deal. And then you get a product, you get a score, right? So with all the score added up, there is a passing and failing score. That's how we qualify the deal. So some of the major parameters include.
I love that. That's brilliant. Love it.
Yeah. So again, nerdy hat, right? So I think, you have to be, this the engineering kind of way to look at things. Everything is, can be quantified. There's a very empirical way to look at things. It's database, right? So everything has something to back it up with data, with a strict algorithm. The algorithm is ever evolving and refined based on more and more deals that we do, what turns out well, what doesn't turn out well. So you just like machine learning, you feed that data into the algorithm to make it better. So as far as the parameters, some of the most important parameters is the park-owned home versus tenant-owned home ratio. So what that means is that, in mobile home park, you're really getting to a parking lot business rather than a rental business. You have to think it that way. So you want to own the land underneath the homes. You don't really want to own the homes themselves, right? It's not a deal breaker, but it's extremely important, especially for small parks, to have majority tenant-owned homes. So the park-owned home versus tenant-home ratio is extremely high weighted. Another thing is,
what do you look for? What's the ratio you look for there? I'm so sorry.
No.
I just
It
thought.
needs to be, so there are two layers to that parameter. The first layer is the ratio is, it's not really a particular number on it, because you have to look at, for example, the weight is really high, like the weight is 8. So if the park is majority tenant owned, then the score will be high. But if it's 50% tenant owned, then the score gets lower. And if it's not tenant owned at all, then we simply don't look at a deal. So there needs to be at least 40 to 50% tenant owned homes. And the exception to that rule is that if you do have park owned homes, but they're extremely new, let's say they're a 2021 model or 2020 model, instead of a 70s, 80 model, then that changes the stories a little bit, because at that point the homes are new enough to not cause the headaches it would have caused with the older models. So that's one of the major parameters. And other parameters, of course, like utility structure, you want to make sure they're on city utilities. Is it billed back to tenants? Is it not billed back to tenants? Because one of the bigger expenses is utilities, right? And there are, all the 15 parameters are important, but those two are just one of the major ones, because that speaks about the structure of the park itself.
Got it, man. I'm learning so much from you. So 40 to 50% tenant owned is a ratio that you look for. That is one of your top ratios.
At least that, yes.
At least that. Is there anything up there that's really important that you consider when you're looking at a deal, right? That's like right up there with a percentage of ratio earned. And a second part question to that is, as a in your expertise in your line, right? As a mobile home park owner, what are typical expenses that maybe a listener is listening and I want to learn, right? I want to learn from you. What are typical expenses that a mobile home park owner would have? For instance, in multifamily, we do a back of the napkin, evaluation underwriting, 50% ratio. Expense ratio is a very well ran multifamily, right? Boom. And then we just back into the cap rate from there. Real quick, 50,000 foot view. What is that for you guys, right? On the mobile home park, what is the expense ratio there?
So
it was a two-part question.
Home parks, for a small park, our expense ratio is usually 40% to 45%. Sometimes 50, depending on the size and depending on who is paying for utilities. If the park is paying for utility, like we pay for utilities, then the expense ratio will be 50% because it's a small park. And if the tenants pay for utility, you're looking at 45 to 40, 40 to 45. So it is lower. For a bigger park, you're looking at 30%. But bigger parks, you also buy it at a much lower cap rate. So you have to balance those. So, when you look at a deal, there are two categories you look at. Number one, the side is economics, right? The numbers need to work out. You need to buy at a 3-point spread, which means that the cap rate and the interest rate needs to be 3%, the difference. That's how you can make some money in there. There needs to be some spread there. And the other part is very important, is operational, right? The park itself, how they're looking, right? So if you're looking at the pictures of the park, you're driving through the park and you look at the homes, everything's run down, skirting missing, decks missing, handrails missing. First of all, that's an insurance problem. Insurance company would not take your policy, would not issue the policy if your park looks like this, right? So, and that shows that there's no pride of ownership. And that's a problem with the tenancy there. So that's something you need to be careful. So operational wise, you need to care about the deal itself. The park itself, the park structure, the utility structure, and the handrail. And the economic side, numbers strictly. So those two things really need to be working together or complement each other when evaluating the deal.
Got it. And you said, so I just learned something from you. You guys underwrite using a 3% spread from cap to interest. Really cool.
Yes.
I've never heard that before. So thank you for sharing that with me. I'm wondering if that would work in multifamily. I'm going to look into that. I'm just having a
Yeah,
random thought.
I think it should. It's just a math model that should work in any of it. Yeah.
Absolutely, absolutely should. I mean, I'm going to find it hard because, like you said, it's much more difficult because there's so much more competition,
Right.
In that space.
So it
But
is harder to get that spread because your cap rate would be lower and interest rates are rising. So you have no spread usually, that'll
that
be
was
hard.
my next question. Yes, so that was my question. So
Mhm.
in this environment where interest rates are rising, right? Are you guys finding it difficult to find that spread and make deals work using that model? And how are you guys projecting out right now? With today is April 22nd as we record this podcast. Yesterday, the Feds came out and said that they're looking to, in May, take an even more aggressive measure in raising rates, and they're thinking about going 50 bips. Not thinking, I think that's what they're kind of committing to, going 50 bips to fight inflation. How are you guys taking that into account in your underwriting, and how are you guys projecting that out right now in your
Yeah,
numbers?
you're spot on. So the prices are going to lower because of the rates are going
Absolutely.
higher because people are looking for that return, right? So what that means is that when we underwrite a deal and we syndicate deals, so when we project the number to investors, the cap rate at when we exit the deal, right? The sales price we want to be more conservative because in the near future, the cap rate will trend higher, and the lower prices will be lower. So that's something to be careful with. Yeah.
Mm-hmm. So I went to a conference, and I'm just going to share this with you. I went to a conference, Charlotte, in Denver, Colorado, a few months ago. It was actually the day. It's one of the big ones, one of the big commercial conferences.
Mm-hmm.
And what I found interesting, there was a lot of really intelligent people in the room. A lot of really successful, high level, really, really intelligent speakers, really intelligent people in the room. And yet no one from the stage said, considered that rates were going up and that cap rates had to decompress, meaning that prices in the multifamily space had to come down because you got to make a return, right? We're all in this business to make money. And yet all they kept feeding us was all this, how great the real estate industry is. And it is great. And I love it. And it's amazing. Right. But they weren't, I don't know what it was. Right. It's like, maybe they didn't want to tell us, or they didn't, I don't know what it was, but you brought a really good point and you were really clear and confident about it. I could tell your body language and I can hear it in your voice. Cap rates have to go up if interest rates go up, meaning prices have to come down.
Yeah, you got to get the spread. If you don't have the spread, you're not making money. So
why would you buy a property if you're not going to make money? Right.
Right. Like, you buy a property at 2% cap rate and the interest rate is 10%. You're losing money from day one and you never get out of it.
Why would I get this is business 101. So I want to get your perspective on that. What are your projections, right? What are you guys projecting? Because I know that you're really smart. What are you guys projecting out in terms of interest rates, and what's the strategy that you guys are putting together currently to hedge against that and continue to grow your business, right? Because hey, our business is not going to stop. Like I'm not leaving the business. I'm sure you're not leaving the business if rates go up. I'm in this for the long game. So whether rates go up or down, I'm still playing. What strategy are you guys implementing to continue to grow, continue to build your mobile home portfolio?
Right. So mobile home parks, actually, the cap rates are actually, they are going up because the prices are lowering. So because the prices are lowering, we're able to get good deals. So we want to make sure from the acquisition front, we get really, really good deals, meaning that the spread is really big, right? So when the spread is big enough as we grow, because economics, they have a cycle, they go up and down, and real estate has a cycle as well. So I think for mobile home parks as a whole, it is still going up. Yeah, regardless, it could have little fluctuations, but it's still going up. So we don't stop the business. We simply, adjust the strategy and model a little bit, because usually if you are, it's a lot of underwriting to you have to do. So because if the rates are going up and the prices are lower, like I said, you need to project a lower sales price when you sell, because it's more likely the prices will not be as high as you like it to be within time frame, or you could plan for a longer hold. But for us, we usually do a 2 to 3 year hold. We're a shorter hold company. But I think, especially we're shorter hold, and we don't expect the price to go up like crazy, though you never know what happens. So we expect it to have a correction to go down a little bit. So we want to make sure we're a little bit more conservative, both from the acquisition side, also from the sales side, saying that, we usually project a 10% cap rate. For example, a good example is that we're actually selling something right now. We projected when we bought the park about less than 2 years ago, syndicated deal, we projected to investors that this will be sold at a 10% cap, right? And we're selling it now. We're actually selling at a lower cap. So you want to be conservative when you project the cap rate. You want to make sure that, especially when the economy is looking like this, especially when the rates are going up, and because we can't fight this inflation and it's going crazy. So. Yeah.
So you're an average of a 2 to 3 year hold, you said is your average hold. My next question for you is, what does a value add really mean in a mobile home park, right? Because I know what it means in a multifamily. We're going in there, we're fixing, we're improving the driveway, we're improving the common areas, we're painting apartments, right? We're adding value and we're raising rents, and boom, right? We're increasing and increasing value.
Yeah.
What does value add mean in your space, in the mobile home space? How do you add value, let's say, to a park that's owned 100% by tenant owned, right? That's a good deal for you, right? 100% park, tenant owned park. And so you don't own any of the homes, you own the lots. All right, so explain to us, where is the strategy there? Like, where is your value add there? Because what are you improving, the roads?
Yeah, you can improve the roads, and one of the things is that you can put a sign to the park saying, making it more of a community, right? Call it Whispering Pines or whatever. Just you need to put a sign up front at the park with management information on it, and you another thing that we do is to put white fences around the kind of a curb of the park to give it a kind of a country feel, to give it a sense of community, to make it a neighborhood. And obviously the upkeep, landscaping, that's all the repairs and maintenance stuff. And cosmetic upgrades, you can beautify the entrance, beautify the sign, and that's pretty much, and then also the road work, obviously. But I think the majority is going to be the cosmetic upgrades. And also there's another more expensive value add is infilling, right? If you have vacant lots on your land and the vacant lot has utilities set up, you can make your park more attractive to attract other tenants to bring their home, because they own the homes, right? To attract their homes into your park. So that way you have your vacancy filled, and that is a huge boost to your NI, thus the value of the park.
I love it. Thank you so much, Charlotte.
Yeah.
For sharing all of your knowledge and all of your information with us. If I know that you're raising capital, you raise capital for deals. If any of our listeners would be interested in connecting with you, and maybe they want to know about some of your deals, how could they get a hold of you to get more information, connect with you, what's your next deal, and just kind of connect with you to find out how to get in on one of these deals that you do?
Right. So just go to our website at johnscreekcapital.com, and there will be a short form to fill out. And I usually reach out within a couple hours, and I will usually set up a call with you to discuss your interest, and we'll go from there. Yeah.
And where, last question, what markets do you focus in? So what areas do you buy in
So we
specific?
actually own parks across different states, but the majority of our parks are focused on are in the Southeast and the Midwest, largely due to the quality of the deals, the quality of the parks, and the economics, and also the legislatures.
The legislatures. Okay. All right. Perfect. Well, thank you, Charlotte, for being here today. I really, really appreciate it. I learned a ton from you, and I'm sure my listeners also learned a ton from you. Thank you so much. I look forward to seeing all the great things you're going to do, and I hope to. You know what? I'd love to have you back as the economy continues to turn. No one knows where the economy is going. I think we're headed we're headed for some sort of correction. Obviously, with the interest rates going up. My opinion. And I like to have you back when we're in the mix of everything and see how things are playing, because you are playing a very, very vital role in America. We have an affordability crisis, right? And you're solving for that with what you're doing. It's kind of my blue ocean as well. We buy certain deals. We like to buy C class and B class, or C and C class neighborhoods, but the deals got to be priced at such a point, and I have a whole marketing team. It's got to be priced at such a point that we can rent it, we can make it really affordable. We're not following what everyone else is doing. We make it really affordable, that regardless of how high rents are going, that we can buy it at this price point. We could put the rents at this point, and we're giving a good, clean, safe, quality product. And it's not all the way over here, but it's still very profitable for us at this price, right?
Right, exactly.
That's our strategy. We're not necessarily following what everyone else is doing and what the market's doing, because we know how that all can turn out when you follow what everyone else is doing. You got to spend the time. So thank you so much for being here. Really, really, really appreciate you. Thank you for all your wisdom and your insights within your sphere. And please, guys, reach out to her, johnscreekcapital.com. Also, her email is cdunford@johnscreekcapital.com. Is that correct?
Yes, that's correct.
Charlotte, thank you so much, dear. And I appreciate you. Thank you for being here. Really, really, really grateful for you coming here today.
Thank you so much for having me.